The pandemic created a massive upheaval in the entertainment industry as consumers rapidly shifted to online content consumption, forcing many legacy media and broadcast companies to adapt as old business models quickly fell by the wayside. But as Hollywood begins to emerge from COVID shutdowns, what will the new normal look like? And how will companies continue to remain resilient in a growing digital landscape? And joining me to discuss all this is John Harrison. He's the America's Media and Entertainment Sector Leader at EY, and they've released some new data which looks at the top priorities of entertainment executives to remain competitive in a post-COVID world. So John, it looks like there's some sort of light here at the end of the tunnel. And as we kind of take a step back and look, can you just paint a picture for us of just how disruptive this pandemic was and what it actually means to be resilient for the entertainment industry as we come out of this?
Yeah, thanks, Alexis, and thanks for having me. We did a deep market study of the industry over the last 5 or 6 months, trying to understand exactly that question. And over 50% of executives came back and said the effects of the pandemic have permanently changed their business. Some of this was accelerating long-running trends that have been impacting the industry for a while now, but the pandemic really put an exclamation point on that. And nearly 50% of the respondents to our research said that becoming more resilient, making their enterprise more resilient, is their top post-pandemic priority. And what they said they're going to be focused on is really four things. First, simplifying the enterprise, becoming more efficient and effective. Second, innovating at scale to rapidly develop new business models to react to the changing landscape. Third, protecting the enterprise, and this is especially relevant now, just given the increased cyber threat that we're seeing across the world today. And then fourth, reimagining the future of work and understanding how, as we emerge from the pandemic lifestyle and really the working style, how our employee bases are going to operate in a hybrid model and how we're going to serve our customers. So those are really the four key areas from a resiliency perspective that media companies are focused on.
Well, yeah, and we look at all these factors of resiliency within the industry. And when you look at the particular segments, because obviously the impact was kind of felt a little bit uneven as you had, movie theaters shutting down, but you had this great streaming boom. As investors look at this, what are some of the segments that maybe have the most ground to make up, or what are the opportunities for growth here as these companies kind of grapple with this?
Yeah, it's a great question, Alexis. As we move aggressively into this reopening phase, at least here in the US, I think the companies across the industry in various subsectors are going to emerge in different ways, especially companies that rely on gathering for their business model. So we've seen strong consumer interest in returning to sporting events. You've got sold out hockey and playoff games happening almost every day now. There's a building demand for live music, so concerts look to be coming back in some force. And theme parks are reopening, certainly in Florida, but also in California. So I think where you have unique experiences that you can only really achieve in person, those areas look to be on a path to a strong recovery. There's a little bit less certainty around parts of the industry where there has been a more developed digital substitution experience. So you mentioned movie going. For sure, I think theaters are reopened. I think there's a pent-up demand for content. We need a little bit more content in the supply chain as it relates to film releases. But I think time will tell how the theatrical window will recover. Another piece is more on the B2B side, so trade shows and conferences. Most of those pivoted quite nicely into a virtual environment, and we're just now moving into the stage of the cycle where those trade shows are reopening. And I think for our B2B media clients, it's understanding how that's going to play out over the next 12 months. I think the last piece is around pay TV. You mentioned streaming. So obviously when we were all homebound, everyone signed up for all kinds of new streaming services. And so that's pressured some of the legacy media models. But for the cable companies, it reinforced how essential that broadband connection is.
Right. And, when we look at, you talked about the business to business, the B2B, but the big piece of this transformation is this direct to consumer relationship that a lot of these companies are, found themselves developing as this was going on. So can you talk a little bit about how that is emerging as an important thing for these companies to look at. And, how can they scale up subscribers when you have just such a growing competitive field in that area?
Yeah, the pivot to direct to consumer is super important. And as consumers cut the cord and the pay TV universe shrinks, retaining that connection to the consumer has to happen. And it's taking the form of moving essentially the entire industry from a wholesale model, selling through the pay TV distributors, to a retail model, and making that connection direct to consumer. And it's both for distributing content and increasingly for the sale of advertising. And it's a difficult and expensive pivot. It requires huge investment in content, in technology, including ad technology, and in marketing, because you have to attract those subscribers and then you have to find a way to retain them as well. Managing that churn is key. And so because it requires scale and capital, I think it's also part of the underlying driver behind all the consolidation activity we've seen in the industry over the last few years, and including this year.
When you look at, just the wide range of services, you have your Netflixes, your Hulus, but then you also have HBO Max, Disney Plus, Discovery. There's so many different products with these different goals. How can investors actually figure out which companies are actually succeeding and doing well?
Yeah, it's a tough question. I think right now the market is completely focused on the direct to consumer pivot, and they're measuring that by subscriber growth, or for the ad supported streaming services, monthly average user growth. And that is kind of fueling the stock price performance, at least near term, for these companies. And I think it's important, like subscriber or user growth drives the revenue that underpins the financial performance of these companies. But longer term, I think investors do need to also focus on margins and on free cash flow. And in an industry that's becoming more and more capital intensive, how they convert their operating success and sub growth into financial success towards free cash flow growth is going to be a key financial metric for investors to keep their eye on.
Well, John, thank you so much for your insights today. It's always great to talk to you.
Thank you, Alexis.
And you can head on over to investors.com for more of our coverage. For Investors Business Daily, I'm Alexis Garcia.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.